Welcome. In this lesson, we're going to walk through the full cash and tax journey of owning an income property. We'll look at what happens when you own the property, how the income is treated, and how the tax code can actually help shelter that income along the way. Then we'll follow what happens as you move from one property to the next, and eventually how that investment can be passed on. Let's start with the core idea behind all of this, depreciation. Let's start with the idea behind depreciation. In business, assets are used to generate income, things like machines, equipment, or buildings. And over time, those assets wear out or lose their usefulness. The tax code recognizes this, so instead of taking the full cost all at once, it allows businesses to spread that cost out over time. That's what we call depreciation. So each year, a portion of that asset's value is used to offset income. But real estate's a little different, and that's where things really get interesting. Now here's where real estate gets interesting, and why many investors prefer apartment buildings. Most assets wear out over time. They lose value. But apartment buildings can produce income year after year. Rents can rise, values can increase, but the tax code still treats the building as declining in value. So on paper it goes down, while in reality it may go up. That's the advantage. Now let's look at a real example. Now let's look at our starting point, a $350,000 building. Over time, the property has grown, but something else is happening. The tax shelter is shrinking. Depreciation is now lower than the income, so the income is no longer fully sheltered, and now taxes show up. This is where you lose your tax shield. If you want to follow along and see these numbers step by step, you can use the follow along calculator. Grab it below, and let's look at what happens next. Here's the solution, a 1031 exchange. You sell the property for $500,000 with about $250,000 in equity. Normally, taxes would be due on that gain, reducing the cash you can reinvest. But with a 1031 exchange, you reinvest into another income property, and those taxes are deferred. So your full equity continues working instead of losing money on taxes. You keep it invested and move it into a larger property. Now, where did this come from? Section 1031 of the tax code, originally created for farmers who needed to trade land without being taxed each time. Over time, this rule was expanded and adopted by real estate investors, allowing properties to be exchanged without triggering immediate taxes. So instead of selling and stopping, investors can keep moving from one property to the next with no tax liability or a deferred tax liability. Now step two, we take the $250,000 of equity and use it as a down payment on $1 million building. So the same equity controls a larger asset. That means more depreciation. About $800,000 is depreciable, creating roughly $29,000 per year. Now compare that to the income. Depreciation is higher, so instead of taxable income, we now show a tax loss of $15,977. Depreciation exceeds income, so let's see what happens to that loss. Now let's look at that loss. About $16,000 is created because depreciation exceeds income. But this loss does not disappear. It becomes a suspended loss, and it carries forward. It can be used in future years to offset rental income or reduce taxes when the property is sold. So even though you can't use it all today, it still has value and can reduce taxes later. Now let's compare how this works against someone without depreciation. Now let's compare the same income, two different outcomes. On the left, earned income, about $13,114, fully taxable at roughly a 30% rate, leaving about $9,180 after tax. On the right, property income, the same $13,114, but now we apply depreciation of about $29,000, which reduces taxable income. So taxable income drops to zero, no taxes owed, which means the full $13,000 is kept as after-tax income. Same income, different tax result. Now step three, we move up again. Over time, rents increase, loan balances decline, and property values grow. So the investor exchanges into a $2 million building, again using built-up equity, and now the building is larger, which means more depreciation. About $1,600,000 is depreciable, creating roughly $58,000 per year. So the same strategy repeats, but on a larger scale. And if you look at the numbers, you'll see the pattern. As property size increases, depreciation increases. Now let's look at that pattern across each step. Depreciation is based on the building value, not just the cash you invest. So when you use leverage, you control a larger asset, which means a larger depreciable value. So yes, leverage helps increase the amount you can depreciate. As the building gets larger, the depreciation gets larger, creating a bigger tax shelter. So each step up increases both the asset and the tax benefit. That's the ladder. Now let's look at the final step. Now the final step, passing the property to heirs. When the property is inherited, the tax base resets to current market value. That means all prior gains and prior depreciation are not taxed. To the heirs, that's a fresh start for the next generation. So after years of tax advantages, the property transfers without that tax burden. That's what makes this strategy so powerful. Now let's take a look at the total return. Now we can talk about total return, not as one number, but as a structure. There isn't a single source of return here. The result comes from multiple streams working together. Cash flow is one part. It tells us the income supports the loan. Depreciation is another. It doesn't change cash, but it improves the after-tax outcome. Loan paydown builds equity. Each payment reduces the balance and increases ownership. And depreciation sits on top of the entire stack. It magnifies everything, for better or for worse. The total annual return is the combination of these effects. Now let's finish with a key idea. Throughout the journey, income property provides tax advantages at every stage. When you own it, depreciation can shelter rental income. When you sell, a 1031 exchange can defer capital gains. And when passed to heirs, the tax basis can reset. So from start to finish, the tax code helps support the investor. That's the advantage, and that's your strategy.